How the U.S. and other countries experience inflation. In the last 3 decades, inflation has been relatively low in the U.S. economy, with the Consumer Price Index typically rising 2% to 4% per year. Looking back over the 20th century, there have been several periods where inflation caused the price level to rise at double-digit rates. But nothing has come close to hyperinflation. Historical inflation in the U.S. economy. Figure 1a shows the level of prices in the Consumer Price Index stretching back to 1916. In this case, the base years, when the CPI is defined as 100, are set for the average level of prices that existed from 1982 to 1984. Figure 1b shows the annual percentage changes in the CPI over time, which is the inflation rate. The first 2 waves of inflation are easy to characterize in historical terms. They are right after World War I and World War II. However, there are also 2 periods of severe negative inflation called deflation in the early decades of the 20th century. One following the deep recession of 1920-21 and the other during the Great Depression of the 1930s. Since inflation is a time when the buying power of money in terms of goods and services is reduced, deflation will be a time when the buying power of money in terms of goods and services increases. For the period from 1900 to about 1960, the major inflations and deflations nearly balanced each other out. So the average annual rate of inflation over these years was only about 1% per year. A third wave of more severe inflation arrived in the 1970s and departed in the early 1980s. Times of recession or depression often seem to be times when the inflation rate is lower. As in the recession of 1920-1921, the Great Depression, the recession of 1980 to 1982, and the Great Recession in 2008-2009. There were a few months in 2009 that were deflationary, but not at an annual rate. Recessions are typically accompanied by higher levels of unemployment, and the total demand for goods falls, pulling the price level down. Conversely, the rate of inflation often, but not always, seems to start moving up when the economy is growing very strongly, like right after wartime or during the 1960s. The frameworks for macroeconomic analysis, developed in other chapters, will explain why recession often accompanies higher unemployment and lower inflation, while rapid economic growth often brings lower unemployment but higher inflation. Inflation around the world. Around the rest of the world, the pattern of inflation has been very mixed, as can be seen in Figure 2, which shows inflation rates over the last several decades. Many industrialized countries, not just the United States, had relatively high inflation rates in the 1970s. For example, in 1975, Japan's inflation rate was over 8% and the inflation rate for the United Kingdom was almost 25%. In the 1980s, inflation rates came down in the United States and in Europe and have largely stayed down. Countries with controlled economies in the 1970s, like the Soviet Union and China, historically had very low rates of measured inflation because prices were forbidden to rise by law, except for the cases where the government deemed a price increase to be due to quality improvements. However, these countries also had perpetual shortages of goods, since forbidding prices to rise acts like a price ceiling and creates a situation where quantity demanded often exceeds quantity supplied. As Russia and China made a transition toward more market-oriented economies, they also experienced outbursts of inflation, although the statistics for these economies should be regarded as somewhat shakier. Inflation in China averaged about 10% per year for much of the 1980s and early 1990s, although it has dropped off since then. Russia experienced hyperinflation, an outburst of high inflation of 2,500% per year in the early 1990s. Although by 2006 Russia's consumer price inflation had dipped below 10% per year, as shown in Figure 3, the closest the United States has ever gotten to hyperinflation was during the Civil War, 1860 to 1865. In the Confederate States, many countries in Latin America experienced raging hyperinflation during the 1980s and early 1990s, with inflation rates often well above 100% per year. In 1990, for example, both Brazil and Argentina saw inflation climb above 2,000%. Certain countries in Africa experienced extremely high rates of inflation, sometimes bordering on hyperinflation. In the 1990s, Nigeria, the most populous country in Africa, had an inflation rate of 75% in 1995. In the early 2000s, the problem of inflation appears to have diminished for most countries, at least in comparison to the worst times of recent decades. As we noted in this earlier Bring It Home feature, in recent years, the world's worst example of hyperinflation was in Zimbabwe, where at one point the government was issuing bills with a face value of $100 trillion. In Zimbabwean dollars. That is, the bills had $100 trillion written on the front, but were almost worthless. In many countries, the memory of double-digit, triple-digit, and even quadruple-digit inflation is not very far in the past. Key concepts and summary. In the U.S. economy, the annual inflation rate in the last 2 decades has typically been around 2% to 4%. The periods of highest inflation in the United States in the 20th century occurred during the years after World Wars I and II, and in the 1970s. The period of lowest inflation actually, with deflation, was the Great Depression of the 1930s. Thank you for watching BookTube channel. Make sure to smash the like and subscribe buttons to receive notifications about new contents.